Morning, everybody. This is Tim Melvin coming to you from down here in Central Florida. We're supposed to have a rainy couple of days down here. We really do need the rain. Um, so, just getting a video done here on Monday. It's been a couple weeks. We've had a crazy travel schedule. I was sick for a few days in there and just frankly didn't feel like doing it because I felt horrible. And fortunately, it's not like we've come through a period where, we went a couple weeks with no videos and there were trade wars and markets declining. Well, okay, we actually did. But let's keep some perspective here. Yeah, markets have been a lot more volatile. We've seen some days that really got some, accelerated momentum to the downside as people got a little freaked out about the tit for tat game that Xi Jinping and Donald Trump are playing with trade. Now, what's going to happen with the trade war? I'm going to tell you, I don't know. All right. It would seem at first we have the upper hand, right? They buy 4 times as much stuff from us as we buy from them. I'm sorry, I had that backwards. We buy 4 times as much stuff from them as they buy from us, giving us an upper hand in imposing tariffs. They, however, have what is the nuclear option of a trade war. They're one of the largest owners of U.S. Treasury securities. If they were to start dumping those securities onto the open market, and we can argue all day the mechanics of that, whether it's in their best interest and what they'd use as a reserve. But if they decided to really play hardball and start dumping those into the open market, that would drive rates up here on the long end very, very quickly and do some pretty serious damage to the U.S. economy. I don't think they'll do that. I have a hard time seeing how it's in our best interest. But we've got 2 certified goofballs at the helm of these 2 countries who are willing to take things all the way up to the brink. So we'll see how it all plays out. What does that mean for the market? For us as small bank stock investors, nothing. I mean, we're still up for the year. We're doing fine. I like the way we're positioned. Again, we've got lots of cash and we've got the tail hedge in place if things really do go all the way south. So we're in pretty good shape. Broader market, let's perspective again. The S&P 500 before we opened this morning was down about 8.7% off of all-time highs. Now it's a little bit before 10 as I'm recording this, and the market is up at this writing. That means absolutely nothing, as we've seen over the last couple of weeks. This could go either way by the end of the day. The Russell 2000, well, it was down about 5.6% before the open this morning. So, no, selling's never fun, but this isn't even a decent sell-off or correction yet, for goodness sake. It certainly hasn't created any bargains. Valuations are still extremely elevated. If we get a real sell-off, it could go a lot lower than some people realize. Guggenheim Capital was out last week. They had a report on fixed income markets. They are aggressively bearish. They think that we're going to see 8 rate hikes, that the global growth case is going to be strong, or at least strong enough for central banks around the world to misconstrue it as capable of being ongoing. And they'll come out in 8 rate hikes. That's the most aggressive forecast I think I've seen so far, although I think KKR is almost that aggressive. But I think they were at 6, which is still more than the market forecast of 4. If we see 8 rate hikes, that's going to take overnight rates back up to 3.25%, 3.5%. And according to Guggenheim, that's a cash flow killer. That will wipe out corporate cash flow levels, and we'll see something that they think will be worse than 2007. That the new, with corporate debt at all-time high levels as a percentage of GDP, if we get to that 3.5% and over-levered U.S. corporations start to struggle and we start to see defaults, that could very well lead us into the next recession. I don't know if it'll happen or not. As I've said before, there's 3 scenarios. One, we kind of stay where we are, right? 2.5% growth, just kind of rolling along. Interest rates go up a little bit, but not too much. That's wonderful for us as small bank stock investors. It'll accelerate M&A because in that environment, you just can't grow any other way, particularly if you're a mid-cap bank. So we own small cap banks that the mid cap banks will buy on their path to become bigger cap banks. So slow growth scenario, we love it. Accelerated growth scenario, we love that one too, because that increases loan demand, solidifies collateral values, it raises net interest margins, so our bottom line profits go up. We're paying less taxes thanks to the tax reform package on those bottom line profits. Net result, higher stock prices all the way around. Then there's the third scenario where we go into a recession, rates come crashing back down, which is horrible for our net interest margins. But remember, we have a lot of cash and we have a tail hedge in place. So if that happens, it won't be as much fun, say, as an afternoon at the ballpark with cold beer or, having a 10 takeover day or something like that. But we will have tons of cash to put ourselves in a position for the next extended run in bank stock prices. So, if you're around my age or younger, I'm going to be, of course, 36 here in a few weeks, 57 in a few weeks here. We're pretty good shape. I have no intention of going anywhere, retiring for many years from now. If I had, I wouldn't have quit smoking. I mean, if I was planning on retiring young or something silly like that. I like what I do. I'm going to keep at it. So, good. I'm much more worried about asset prices 10 to 15 years down the road than I am today. Now, if I was 70 to 75 today, I'd probably lighten it up and hold even more cash than we currently have in the portfolio. But I don't give portfolio advice. That's a decision that you have to make for yourself. That's what I'd do if I was 15 years older right now. But anyway, big week in baseball. Well, I want to cover one thing. This was an interesting discussion that I had with some old-time value investing pros up in Connecticut this past week, visiting with several old friends over there, and we got to talking about the value anomaly and why it works and why most people have such a hard time making it work for them. Because over time, the value edge is, depending on the firm, anywhere between 200 basis points to as many as 500 basis points. You think it'd be a no-brainer just to stick with it. Here's what we came up with, and it's the periods of underperformance. Most people can't handle it. Even Warren Buffett, about 20% of the time, actually I think a little bit more than 20% of the time, has lagged the S&P 500, sometimes for a few years in a row. When Charlie Munger had his partnership, he once went 4 out of 5 years underperforming the market. Now, even though in the decade that contained that period, he outperformed the market by 4 to 1, I'm pretty sure his investors were a little rough on him during that 5-year stretch. And that's what happens with individual investors. You adapt a value style. It does well, underperforms for a couple years, and you're moving on, looking for that next hot internet fund, hot internet stock, the new biotech miracle whiz kid $1,000,000 to 1 potential stock. And you're chasing performance, and that doesn't work. Once you've identified a style that works, and there's a couple that we know work very well. Value works very well. Momentum works very well, and you can mix and match value and momentum with some really interesting results as well. These things all work very well. So if you find that you have a manager that is capable, that you trust, that you believe in, you need to stay the course because you will have periods of underperformance, particularly, by the way, in near the end of a bull market when stocks are really hot and they're moving up like they have been in 2017, and you're lagging behind, and your cousin's stupid nephew is in the basement making $1 million a day day trading stocks nobody's ever heard of, and rumors of people just getting rich while you're chugging along earning less than the market. That's when it's hardest to stay with the strategy, and it's also when you have to stay with the strategy, because chasing performance means that you're going to be buying bad assets at the top of the market and you're going to take a punishing ride to the bottom. So once you've identified a course and a strategy, small bank stocks, that works very well, and you found someone that's going to guide the portfolio that you can trust, and I'd like to think that is me, then you should stay with it for a very long time and let the magic of time and value compound your money into the fortune that you need to make your retirement and other financial goals come true. That's my lecture for this week. Let's talk about some fun stuff. I finished both Skin in the Game by Nassim Taleb and Annie Duke's Thinking in Bets. Read them. They'll really help you adjust the way you think about the world and the things that you do, not just financial decisions, but life decisions. Fantastic books, both of them very thought-provoking. Excuse me one second. Sorry about that. Did a lot of recreational reading because a lot of travel, and I tend to want to read on airplanes and in hotels. So had my Kindle fired up, probably read, 10 to 12 books over the last 2 weeks. I won't bore you with the details. You can follow me on Goodreads. I give them all my rankings. Really good, entertaining books. And the next few weeks, boy, we're getting into that spring. This is almost as good as Christmas. We've got Ace Atkins out with the latest chapter in the Spencer series. That'll be out the first week of May. Stuart Woods has a new book coming out. There's a new Preston and Child coming out. There's a new Alex Hawke novel by Ted Bell. Just if you've got a favorite author and a favorite genre in fiction, probably coming out with a book over the next 8 weeks. So check it out on Amazon. This is a great time to be a recreational reader. Got to go on a family vacation in June. So I'm going to be loading that Kindle absolutely to the gills. These people want to do things like swimming in a river in Texas. And yeah, no, I'm going to sit under the cottonwood tree or the live oak tree or whatever it is and read a book in Texas. That's going to be my vacation. So lots of great books coming out. Check it out. And I said you can follow what I'm reading on goodreads.com. Now, on to Major League Baseball. Shohei Ohtani has had himself a year so far. ERA of 2.08 in 2 games. He's got 18 strikeouts so far. And on the other side of the plate, he's only hitting .389 with 3 home runs and 7 RBIs a couple weeks into the season. He didn't look so good in spring training, but I tell you what, once they flip the switch to the regular season, this guy is exactly as advertised, and he's going to cost me a lot of sleep playing for the California Angels this year because those games start at 10 o'clock on ESPN most nights or MLB TV. Orioles, we just took 3 out of 4 from the Yankees, which is fantastic. A lot of heart in this thing because the pitching is spotty, but they got a lot of heart. They got Buck Showalter. We'll see how far that can take them. We've seen some signs of improvement in the pitching. Kevin Cashin's second outing was fantastic. Gossman's was solid. Dylan Bundy looks okay. After that, you got kind of a dark hole. So we'll see where the pitching and Buck can take us in 2018. I remain hopeful, but with the Yankees and the Red Sox in the division, it's going to be difficult to even make it into the wild card. But it should be fun to watch. That's what it's all about. So, if you read my baseball update, I'm not sure how many of you did. I picked the Astros and the Cubs. I truly believe those are the 2 best teams in baseball right now. A lot of side stories involving teams like the Chicago White Sox that are up and coming, the Minnesota Twins. Of course, the Indians are still one of the better baseball clubs in the league. I think the Milwaukee Brewers, they're about a year out from being a serious contender and giving the Cubs fits in the National League Central. The Mets stay healthy, they're going to be in this thing, but I think it comes down to the Astros and the Cubs. Now, lots of folks were hoping for that Yankees-Cubs World Series. Now, that would have sent Major League Baseball executives and network television executives to the hospital with an erection that lasted longer than 4 hours because those are 2 huge TV markets, and both teams have a fan base that extends all over the world. The viewership on that World Series would have been off the charts. It's a possibility, but I really think the Astros will take the Yankees in any 7-game series. They're just the pitching staff is just that much better, and the lineup doesn't have quite as much power, but it stacks up pretty good. And the Cubs, they remain the class of the National League, in my opinion. So that's my prediction for the year. Been pretty accurate the last couple of years. We'll see how it all comes down this year. Anyway, looking out at the world, the markets, what's going on, the politics, all I can say, buy small bank stocks using the parameters that we've laid out over the years, and I think you'll continue to do very, very well. So this is Tim Melvin of Banking on Profits and the Community Bank Stock Investor. I will try to be a little bit more timely and get these videos out once a week again, but no promises. We have some more travel coming up, and that just always makes it difficult to sit down and spend some time to shoot the videos. Hopefully, I'll talk to you guys next week.